Hello, everyone, and welcome to this video on accounting cycle step 3, which is ledgers. Now, where we left off in the accounting cycle was with step 2, which were journal entries. And journal entries are a very important step and very useful. They serve a certain purpose, right? The purpose of journal entries is to tell us what was exchanged in each transaction. So for example, if you look at this transaction here, or this journal entry, we see supplies. Well, they're an asset, and that asset is debited, which means our asset is going up, which means we received supplies. Then we look at the other side of the entry. It says cash is credited. Okay, so cash is an asset, and that asset is credited, which means it's going down. Well, that means we gave cash. So that tells us, again, what was exchanged in the transaction. We gave cash, and in exchange, we received supplies. Well, that's very important information to know, but it doesn't tell us everything we need to know as accountants and business people. For example, what if the company needs to buy more supplies? Well, how much cash do they have in order to buy supplies? Do they have enough cash? If they don't have enough cash, well, then maybe they need to buy the supplies on credit. But we won't know that unless we know how much cash we have. So that's where ledgers come in, and that's step 3 of the accounting cycle, which is post to the ledgers. Okay? So what posting means grouping together all transactions affecting an account into the accounts ledger. And you notice here I have a picture of a filing cabinet, right? And so that's kind of what posting is. It's filing all of the journal entries into their respective accounts. Okay? So ledgers are kind of like the filing system of accounting. Each account has its own ledger or file that shows all transactions that affected that account, both the increases in that account and the decreases. So if you notice here, we have, the cash file, the accounts payable file, the common stock file, right? These are all the ledgers. And as different transactions come in, we're going to file it there. So let's say, for example, we received cash. Well, we're going to file it in the cash file. Or let's say we buy something on credit, we're going to file that in the accounts payable file. Or, an owner puts money in, we're going to file that in the common stock file. And we'll just continuing filing into each of these categories depending on, as the transactions come in. Then what that allows us to do, once we have all of the transactions that affect a certain account all together in one place, that allows us to calculate what we call the balance or total in each account. So that's kind of like what you're seeing here, right? Here's the cash account, and we've got, these are debits, so this is the money coming in. These are the credits, so that's the cash going out. And then here is the balance saying, okay, well, you have $400 of cash at the end of the month. And then from there, you can decide, well, do I want to use my cash to buy supplies, or do I want to buy the supplies on credit because I don't have enough cash right now to be able to buy these supplies? But we wouldn't be able to know that if we didn't have all of those cash transactions put together in one place, because otherwise they're all like split up between all of the journal entries. So what you're seeing here is a really simplified version of a ledger. So what I want to do is show you kind of a more detailed version of the ledger, what it would actually look like, and kind of explain all of the elements of a ledger. All right, so first thing you'll see is at the top is the account name. So for example, this is the cash ledger. And that's important. That's how you label every ledger. Just like if you had a filing cabinet, each file would have a label. Then from there are two different sides of the ledger, the debit side and the credit side. And of course, debits are on the left and credits are on the right, as we have learned. So that means that all of the debits in that account are here, and then we filed all of the credits to the account over here. At the top, you see that it says BEG. That stands for beginning balance. And what that means is if you look at this ledger, all of these dates are dates in the month of January. So this particular ledger is showing us all of the cash activity in the month of January. But if this business has been going on for a while, then hopefully they started the month of January already having some cash that they've built up from previous months. So that's what this BEG is. That's telling us what was the beginning cash they had at the beginning of January. And you see here it was $80,000. Then throughout the month, they spent cash and they received cash. And then at the end, you see the balance, right? And the balance, is dated January 31st, so that's the end of the month. And that tells us that at the end of the month, the company ended the month with $16,600. That is the ending cash balance. Okay, a few other things I want to point out. First of all, if you notice here, right, the major lines of the ledger form the shape of a T. And that's why sometimes ledgers are referred to as T accounts. If you ever work in an accounting department, you'll be hearing them talk about T accounts all the time. So I just want to make sure you know that they are referring to the ledger. The other thing I want to point out is the dates. Now, the dates are important because they allow you to cross-reference between the ledger and the journal entries. So for example, if I was looking at this ledger, the number that would stand out the most to me is probably this 52,000 because that's the biggest amount on there, way bigger than anything else. And so I might be wondering, God, that's a really large cash transaction. What did we buy for 52,000? So if I wanted to know what I bought for $52,000, I couldn't remember, I would go back to my journal entries with the date of January 21st, and then I could find out, oh, I bought a delivery truck for $52,000. Because then again, my journal entry is going to show me the exchange, right? What I got in exchange for this 52,000. The ledger doesn't show me that. The ledger, remember, the purpose of the ledger is to show me the balance. But if I wanted to know kind of the detail of what made up these different transactions, I can always go back to the journal entry to find out what was exchanged. And when you're doing your homework, they might not put the dates in there. They might give you instead a transaction number or a transaction letter. It doesn't really matter. The point is that it's got to be some way that you can cross-reference back to the journal entry from the ledger. All right. So now let's talk about one more kind of how like the actual mechanics of posting to the ledger. So what you're going to do is you're going to start first with your journal entry list. So this is all the journal entries that you recorded in step 2. And that's here, right? This is just giving you one example. And you go through your list and you go account by account, starting first, as you can see here, with the cash account. So this is a cash account here in our journal entry. So we're going to pull the cash ledger or the cash file folder here. Okay. And if you notice, the cash account in the journal entry has a debit of 80,000. So we're going to file that 80,000 here on the debit side, right? Debit and debit. And then of course, we want to date that transaction in case we ever need to cross-reference back. So we have the date there. Then we're going to go to, again, keep going down that list of journal entries. The next item in our list is common stock. So now we're going to pull the common stock ledger. And if we look at our journal entry of common stock as a credit of 80,000, so we're going to record or post that onto the credit side of the common stock ledger. And then of course we want to date our posting so we can cross-reference back to the journal entry if necessary. Now, the next step I want to talk about is calculating the balance. And sometimes students get confused about how we do that, but it's really a lot more simple than you think. And in fact, this is probably math that you did when you were in elementary school, right? So when you were in elementary school, you added positive and negative numbers, right? So here's an example of a math problem that you might have had in elementary school, right? 1,000 plus 100 minus 200 minus 500. Well, what would the answer to that be? I'll give you a few seconds to figure that out. Okay, well, hopefully if you did your math right, you calculated that comes out to $400. Okay, well, a ledger is pretty much the same thing. The difference is that instead of putting the positive and negative numbers all in the same column, we put them in two different columns. And this is where your debit credit rules come into play. So what you have to do with your debit credit rules is you first look at, okay, what type of account is this? Well, this account is cash, which is an asset account. And our debit credit rules tell us that for an asset account, debits are positive numbers or increases, and credits are negative numbers or decreases. So you notice here, these two positive numbers are on the debit side, and these two negative numbers are on the credit side. But the balance, again, comes out the same. So you would kind of consider it the same way. This is positive 1,000, positive 100, minus 200, minus 500 is going to equal positive 400. So you put it on the positive side. Okay, that's how you calculate a ledger balance. Now let me show you one more thing. Again, it's really important to figure out the account type. So the steps in calculating the balance, again, are first, look at the account type in the debit credit rules to determine which side is positive or negative. For cash, as we said, that's an asset. So positives are on the debit side, negatives are on the credit side. But if you look here at this account, accounts payable, well, that's a liability. And for liabilities, if you look at the debit credit rule, it's the opposite, right? You have positive or increases are on the credit side and negatives or decreases are on the debit side. But it's the same kind of thing. These are going to be your positive numbers. These are going to be your negative numbers. So if you wanted to make it a math problem, like a simple one like you had in elementary school, you would just go, okay, positive 600 plus positive 400 minus 300 is going to equal 700. And it's going to equal 700 positive, so you're going to put it on the positive side. So again, it's that same kind of concept. You just have to look at the account type, figure out your debit credit rules to know which are positive and negative. You add or subtract the numbers just like you would in elementary school. And then you put the balance on whichever side it is, right? If it's positive, you're going to put it on the positive side. But that brings me to one more thing, right? The balance, if you want to make sure you did it right, should always be what we call the normal balance for that account. Well, what does that mean? Well, let me show you. Okay. The normal balance is whatever increases the account. In other words, you can't have a negative number. Because if you do, that means you did something wrong. You've got to go back and check your numbers. So for example, let's look at asset, right? Okay. You can have $100 cash, right? And if you then spend that $100 cash, that's a negative. How much cash does that leave you? It leaves you 0, right? So you can have cash or you can have 0 cash. But would this work? If I had $100 positive cash and then spent 110, is that even possible? No, I wouldn't even have $110 to spend. That's not possible. You can't have negative cash. Either you have it or you don't, but you can't have negative cash. Therefore, if that comes out that you have an asset with a negative number that's not a debit, that means you did something wrong. You have to go back and check your work. Okay, the same thing with liabilities, right? If you owe somebody, let's say this is accounts payable, you owe somebody $100, you pay them back $100, now you don't owe them anything. But what if you put this? If you owe somebody $100, would you pay them back 120? No, you wouldn't pay them back more than you owe them. That just wouldn't happen. That would give you a negative liability. You can't have a negative liability. So again, your liability should always have credit balances because that's what increases that account, and you can't have a negative liability. With equity, as we previously discussed, those accounts only move in one direction. So common stock and revenues are always going to have a credit balance. Expenses and dividends, they always decrease equity, so they always have a debit balance. So as you're doing your ledgers, make sure that you put the balance on the correct side and double check your debit credit rules to make sure that it's reflecting the normal balance. So again, one thing I want to reiterate is also what I have sometimes students want to do on these types of problems is they want to do something like this. Okay, well, 1,000 here and 100 here gives you 1,100. And 200 here and 500 gives you 700. That is not a balance. Okay, remember the balance tells you the total cash at the end of the month. This doesn't tell me the total cash at the end of the month. It tells me 1,100 came in and 700 came out, but that's not what a balance means. You should only have one balance and it will go on one side, either the debit or credit side. Okay, so make sure that you understand what the term balance means. There's only one, and it should be the normal balance because the normal balance is positive. You'll never have a negative balance. So if you have 1,100 coming in and 700 going out, that gives you 400 left at the end, and that's what your balance is. So I hope this was a helpful video for you to help teach you about how ledgers work. But if you have any further questions, please feel free to contact me. Thanks so much. Bye-bye.